Hello, my name is James Woodburn Group Publisher at Port Phillip Publishing and Fat Tail Media. And what a week it's been. We woke up this morning with the news that the London Underground in the UK has been closed due to the coronavirus for the next 3 weeks. President Trump yesterday announced that they're banning all travel from Europe to the US. And overnight, the Dow Jones dropped by about 10%. It has been a crazy week. It just feels like each day there's new bits of news coming out, and the previous day just feels like it's from another era. To find out what's going on, we decided to get a few people in the room to talk about it. We've got Shae Russell, the editor of the Daily Reckoning, joined by Dan Denning, the global globe-trotting editor for the Bonner and Denning newsletter, and Greg Canavan, the founder of the Rum Rebellion e-letter. Greg, why don't we start with you? I mean, a lot's happened since we last caught up on Tuesday this week.
Yeah, I mean, we've had moves that you would expect to see over a 6 to 8 month period happen in 3 to 4 days. So the word unprecedented gets bandied around quite a lot, but I'm suggesting that what we're seeing now is pretty much unprecedented. We had massive falls in the market over the past couple of weeks. A lot of the readings that I look at in terms of the technical readings on charts, oversold nature of stocks, oversold nature of markets, new lows, etc., all were at historical extremes, and then we get a crash overnight. So obviously the spreading of the coronavirus and the fears that that's bringing about, the news that you just mentioned with society lockdowns, and we're seeing that especially in Italy, which I guess was part of the reason why Trump talked about banning travel from Europe. All these things are just feeding into a mass society fear that's manifesting in the stock market, and it's something that most of us haven't seen. I was writing this morning in the e-letters that we're sending out that you'll read about today. Even in 2008, things weren't as bad as this in terms of the relentlessness of selling. There was heavy selling, but then there was a little bit of relief. At the moment, we are just seeing day after day after day of selling, and that's pure panic. So if we step back from that, what do you do? What do you do when there's blood on the streets? You look to buy, and I know that sounds like a ridiculous thing to say when everyone is really fearful at the moment. We don't know what's going to happen with this virus, and we might talk a little bit about that in a moment. But from my point of view, it is time to really start looking at some good quality stocks to add to your portfolio, and that's certainly what I'll be doing for my subscribers.
Dan, so you came in this morning, you had your face mask on, part in jest. What are your thoughts?
Well, I agree with Greg in general. I think the move doesn't surprise me. The speed of the move surprises me. The market has dropped, and I'm referring here to U.S. markets, a 20% drop, which for whatever reason we consider to be a bear market, is not that unusual. It's just it doesn't usually happen as quickly as it's happened since February 20th. Back in 2008 when we were here, we had a front row seat to the whole thing back then. I looked back because I sort of have PTSD from days like that. But there were days where the Aussie market fell over 6% in September, October, November, and December of 2008. But in between then, there was plenty of respite. And so that was kind of a grinding bear market, which then suddenly had this V-shaped reversal. And I think the one part that we don't know right now, which makes it such an interesting and really an important time for investors, is whether or not this is just panic or whether it's also becoming a larger issue about liquidity in the financial system. And that's the thing that could drive the market not just 20% down, but like it was in 2008 where you go 48% down or 52%. And you are seeing some signs of that in the US. That's why the Fed got involved in the market overnight. But as we've discussed privately, this is not the time to make a big decision to sell. The building is on fire when they talk about fire sales. So the best time to buy is after the fire. And it's going to be nearly impossible psychologically for people to make that decision. And our risk right now is that we're too soon. But in the context of the conversations we've had here, if there is liquidity disappearing in the system, if people are forced to sell whatever they can sell in a market like this, then there's only a few assets that I think you really want to own. Hopefully you have a large cash position. Hopefully you already have some gold bullion if you've been listening to these guys. And after that, then you can start doing what I think Greg's going to do, and I think what Shae's going to do as well, is say, okay, now that everyone has sold and everyone who's panicked, what is there that I can go out and buy now that is so much cheaper now than it was just 2 weeks ago?
Shae, what's that asset for you?
Well, look, unsurprisingly, it's gold. I just want to point out that I agree with both Dan and Greg in the similarities to 2008, except the speed. As they pointed out, it was quite slow that in between the crashes. The thing was with that is we were able to digest the news. This time around, we're not able to digest the news, and I don't know about anybody else, but I'm being hit with some very dramatic headlines. So I'm swinging from one article to another. And I'm finding even myself that I'm being just confused with so much information, conflicting information and contradicting information at the same time. So I can relate to a lot of investors where it's really hard to process what's going on. But the important point is, and this is what both of these two have just expressed, is that it is presenting opportunities. Now, gold sold off overnight, and I'm sure we're going to talk about that in more detail. I literally just put an order in with my bullion dealer this morning to take advantage of this to go get more. And I hope other investors can see that opportunity too.
Well, what I noticed that was very interesting about the gold market is that it actually crashed in US dollars, but it's rising in Aussie dollars. Can we maybe talk about that and explain what's actually going on?
If it's rising in Aussie dollars, it's pretty much just reflecting that the Aussie dollar is falling in relation to the US dollar. So it doesn't mean that it's gone up in US dollars, as we know it went down, but the Aussie dollar weakened. I hate talking currencies. The Aussie dollar weakened, so that's driven the Aussie dollar gold price higher.
I think also what you're seeing, if you look at gold in all currencies, is a general decline in paper money against the value of real assets. And to me, that's the real wild card for what eventually might happen with gold stocks. Is two things happened in the last 24 hours that didn't happen in 2008. That the institutional response, the political response, and then the central bank response didn't calm things. They actually amplified volatility and uncertainty. So things were pretty much stable, not great, but stable, and then the travel ban was announced. And then the Fed did something which in the past would have driven the markets up much higher, and it did for a time. The market rallied almost 1,200 points in the US when the Fed announced that it was going to provide almost $1 trillion in liquidity. And then it closed on the lows. Now, the big difference between today and 2008 is the central banks don't have any room to cut rates. So they can take them negative, which they may very well do in the coming days. But anything else they do is going to have to be pretty much uncharted territory, either much more aggressive stimulus in terms of buying stocks or buying bonds. And again, if you look at that sort of reverse pyramid of assets, what is it? Where do you want to be on that pyramid? Well, maybe you want to be in some stocks that are correlated with things that are going to do well. But that to me is the key difference between now and 2008 is the central banks just have a lot less flexibility.
There's one other key difference that I think is worth mentioning. In 2008, we effectively had a systemic crisis that the global banking system was insolvent due to a bursting global property bubble. So 80% of bank assets, or roughly around that amount of bank assets, is land and property. So when land prices fall and they fall below the value that the banks hold them on their balance sheets, you get bank insolvencies. So that sparked off a round of contagion fears. Banks won't lend to each other because they know that they're insolvent. So everyone has to look to the central banks for support. I think the difference this time around is you're not seeing that decline in global property markets. So the banks themselves are systemically sound. I mean, there will be exposures to corporate credit, falling oil prices, those sorts of things, but not in a systemic way that we saw in 2008. What I think you're seeing now is a massive re-rating of multiples because earnings are going to come down in the next couple of years. So we had a huge rally throughout 2019 when earnings estimates for S&P 500 companies did not rise, and the estimates were expected to kick in FY20 and FY21. That is completely being unwound. So you're seeing a valuation contraction. So it's effectively an earnings recession that the market is really pricing in. So the way I look at it, and what I think what I hope to try to do for my subscribers is put the rational hat on and say, okay, what does this look like? In bull markets, investors price earnings out to 10, 20 years and say, look, in 10, 20 years, this company is going to be X amount, and I'm prepared to pay for that now. In bear markets and what we're seeing now, the time horizon narrows and everyone's looking at the next 1 or 2 years and thinking, oh my goodness, we're priced this stock too high, earnings are going to come down, and that's why share prices are falling. But if you think about the valuation of a share, it is all the future cash flows of a company discounted back to today's price. So this is why I'm not necessarily. I remember 2008. The system was under threat. The system was about to collapse. I don't think that's going to happen this time around. I think we've got a very acute situation with a virus that we're not quite sure at what point it gets contained, although there is some good news coming out of China and South Korea that is abating a little bit, and I think you'll see that happen in Western countries in the next month or two. But right now it's causing a massive disruption to the earnings of companies around the world, and I think you're just seeing a huge derating of earnings multiples. And I think, I'm not saying go out and buy everything today, but I'm saying over the next 6 to 12 months, you should have a plan of easing into this market and buying, because I think it'll be an amazing buying opportunity.
I'll definitely agree on the earnings part.
You can disagree on.
Well, I totally agree. I disagree on the first part, because I think you're correct that the multiple expansion that drove stocks up 32% last year is contracting, and now you have this huge uncertainty about what earnings are going to look like if you have the second and third largest economies in the world go into some kind of lockdown for 2 months. At the minimum, that's disruptive. I think systemic risk is still present. It's just moved. So it was in the banking sector in 2008, and most of it was concentrated in commercial and residential real estate. But global debt has grown since 2008. It's just grown on different balance sheets. So it's now on sovereign balance sheets and corporate balance sheets. So the global debt to GDP ratio is over 300%. It's $253 trillion. And so now the risk is in sovereign bonds and in corporate bonds. So corporate bonds to me would be the most acute risk right now. These are the people that are going to be most distressed in this environment. And that's probably where the central banks are going to be most active. But I don't think it's unreasonable to discount whether or not sovereign bonds, U.S. Treasuries, for example, are risk-free assets anymore. And to me, that could be the huge sea change from this event, that for our entire investment lifetime, not only have U.S. Treasuries been the most liquid asset in the world, but also have had the reputation of being the most risk-free asset in the world. If that changes, what replaces it? And of course, I think I would say probably gold or precious metals. But in the meantime, it's that just sets a lot of things in motion that we don't know how they're going to turn out. So to me, I wouldn't discount that the systemic risk is still there. It's just moved into a different asset class.
Yep. Also in China, obviously the government has a lot more power to just order people not to congregate, to stop people socializing. Here it's a bit more tricky. I think we were talking about this earlier, right? I mean, people have to do it voluntarily.
Well, I think it's a totally separate conversation, and we would have it on the other side of this crisis. But there are going to be people who say that this highlights the benefits of living in an authoritarian state, because it's only in an authoritarian state can you restrict travel, can you forcibly detain people, can you close businesses, you can postpone debt payments, you can completely freeze the financial system until you get a physical problem like a pandemic under control. So the worst result, other than the financial result, which is already concerning, is that this becomes an excuse for instituting more surveillance, more draconian measures on travel, and that those become permanent. And I'm fairly skeptical on that, but we'll see. I think Australia and the U.S. have this window where they can respond to the crisis, and hopefully it doesn't become a catalyst for living in a surveillance state. Although, in my view, we're already pretty far down that track anyway. Sorry, I know that's gloomy, but...
Yeah, we'll end it on a very serious note there. I hate to say it, but I think Dan might be onto something there with it being a catalyst for further moving into a surveillance state. So I know somebody who was being tested for coronavirus just recently, and they were telling me that the doctors even turned around and said, it's not so much that we're worried about you being sick, you'll be fine. He said, but if you are confirmed to have the test, you basically end up locked in a room with somebody going through every minute of your move for the past 2 weeks of your life, who you've come in contact to, where you've been. And they're trying to map out what's happening, how the virus is moving, who may be infected. And just trying to accumulate that data sets in motion the pathway for national surveillance. So I agree with Dan, it's definitely a catalyst for that. It's obviously something I've sort of raged against in the past. But I do definitely believe that we are moving into uncharted territory in regards to what central banks will do, what governments will do in order to prevent losing control of, I'm being a bit drastic saying this, but of basically a fair currency experiment.
Well, I think that feeds into what Dan was saying. We don't know what central banks and governments are going to do precisely, but we know they're going to do something.
Yeah.
And that means more fiscal spending. That means unconventional monetary policy. I mean, what's the RBA's got effectively 25 basis points left in the gun. So by the end of this year, within 2 months perhaps, we could be seeing some unconventional stuff. And that feeds into what you're saying about the creditworthiness of sovereign debt and how the market decides to look at that. At the moment, the market is looking at it as a safe haven. There's capital flowing into that. You're seeing yields at historic lows, which means prices are at historic highs. So effectively, the market hasn't reached a verdict on that.
That's right.
But I think within, let's say, 4 to 6 months, depending on how prevalent this virus is, and I'm reasonably sanguine about it. To be honest, I think if you look at the probability of something going really bad, or the probability of it fixing itself up through isolation, through mitigation effects, then I'm reasonably confident that we should be able to manage this within a couple of months. But right now, when you're in the eye of the storm, it just seems like that point in time is a long way off.
And just for a little bit of perspective, Dan and I were looking at the chart of the S&P 500 just before this conversation, and it's really only gone back to September 2018 levels.
Yeah, I mean, a lot of people will remember that on Christmas Eve or here it was Boxing Day probably, but Steve Mnuchin, the U.S. Treasury Secretary, got on the phone, and suddenly what looked like a bear market in the making was down 18 or 19%, reversed. And I think the S&P had gone up 44% from that day until February 20th. So in that context, it's it's like I said, it's just a normal drawdown. But I guess my concern would be, you go back to 2008, and there should have been probably a bigger reckoning for the highly leveraged players in the financial system. But instead, what we got over the last 10 years was low interest rates. We got a huge boom in passive investing, which is really lazy money in the market tracking the index, and then started to get more trouble last year in September in the repo market. So I think these things have been going on for a long time, which is why the correction doesn't surprise me. It's whether it turns into something else. And really, no one expected that a bat virus from China would be the catalyst for a revaluation in shares. That's the big surprise. But I think Greg's quite right, and Shae's right too, that the focus from here has to be, okay, how do I make sure I avoid the big loss from here? And two, how do I know when to go against all of my instincts and pick up the phone or go to the computer and, I think as Greg said, hold your nose and buy. There will be a time for that, and no one will want to do it when the time comes. No one will want to do it, and that's where you're going to have to force yourself to do it, or listen to these guys.
So what's the time for you? It's not now then?
No, I don't think so. But, Bill and I in the Bonner Denning letter have been quite bearish for a long time.
Really?
Yeah, for most of my professional career. But I guess more importantly, a lot of these things you can't really do anything about, right? We don't have any control over macroprudential regulation, over interest rate policy, over travel restrictions. Anything that's coming, we don't control. I think the view here has always been the only thing you can really control, the thing that gives you the most flexibility when things like this happen, is having wealth or having some financial independence. And so what our goal was to make sure you preserved as much of that as possible in anticipation of something like this. So you manage risk through an asset allocation strategy. You have a plan and you stick to your plan. You don't change your plan suddenly when things like this happen. So I think that's where people who've been around long enough to have seen this happen, calmer heads can prevail. But there will be opportunities. I just don't think they're yet.
Well, I think that's the point, is that you need to have a plan. And I'm not suggesting that today's going to be the low, although I think we are at capitulation crash sort of levels, and I said that a few days ago, and it's just got continually bad. So short-term bounce aside, all that sort of stuff, I'm not suggesting that now is the low and you need to just get into the market en masse, but you need to have a plan for what you're going to do over the next 6 months should the market continue to fall. And my view is that if it continues to fall, you should be scaling into the market and not getting out of the market, because time time and time again, history shows that when you feel most comfortable selling and you feel most comfortable being out of the market, that is close to a low point. So I think, as you said, you have to fight against your natural instincts.
Yeah.
We're evolved to survive and not survive in the stock market. So we have to resist the urge to go into survival mode and buy when you're seeing stocks cheap. When you look at companies and you think, is this a good company that's going to be around in 5 or 10 years' time? And is it trading at a reasonable price or a cheap price? And, as I said, you don't have to go in and buy that whole stake in it today or tomorrow or next week, but you have to look at it and say, well, maybe over the next 5 months, I'm going to buy it in 3 separate lots at certain points in the market. And I think if you do that in another 3 or 4 years' time, when you look back on this moment, you'll be pretty happy with your decision.
I'd like to just back Greg up here, and Dan as well. This is we're seeing a lot of scary numbers every day. This morning I looked and the Dow's down 10%. That's frightening to look at, but in the context of the chart, it's really not that big a drawdown. Now, while investors are obviously being put off of jumping into the market right now, it's an incredible learning opportunity for people to educate themselves further. So take advantage of other people diving out, not by diving in yourself, but by starting to look for sectors of the market that are likely to benefit from government intervention and central bank stimulus. So, for example, China themselves overnight announced that they've got a $570 million stimulus package coming out. I suspect it'll be the first of many. It's a 2-part package. Part of it's going to go into propping up businesses in China. The other part's going to be growth related, which we all know really means infrastructure. That's great for things like copper and iron ore. Also, too, medical stocks could do really well out of this as well. Don't dive into medical stocks, but look for ones that are going to grow with this information. Telecommunication companies could do really well out of this as well. That could come from subsea cabling companies. Just look for opportunities by educating yourself on where you think the money's going to go, and take your time to learn them rather than just rushing in. And as Greg and Dan have said, have a plan over the next 6 months rather than miss out. But use your time wisely, I think, is really what I want investors to take away from what I'm trying to say.
Okay, we'll leave it there for today. Thank you, Shae. Thanks, guys, for making the time to talk. We're going to be in touch as this story unfolds in the days ahead. Thanks.